All right, let's take a look at the markets turning higher now after selling off earlier in the session. At noon, we saw an announcement by St. Louis Federal Reserve President James Bullard that deflation is becoming a real concern. Bullard says that a new form of quantitative easing may be necessary. He's recommending the purchase of government debt in an effort to stimulate the economy and prevent a deflationary style scenario. Is this the right course of action by the Fed? Let's ask CNBC contributor Bob McTeer. He is former president at the Dallas Federal Reserve and distinguished fellow at the National Center for Policy Analysis. Good to have you on the program, Bob. Welcome back.
Thank you, Maria.
So what do you think about Bullard's comments? He's raising the Fed red flag on deflation. Do you agree?
Well, sort of. It shouldn't be news. What he's talking about is common sense and what people would recognize if they'd watched the numbers. People have been under the false impression that Fed monetary policy has been real easy because they've been looking at interest rates. But the money supply has been growing very slowly, and there is room for it to grow faster, and it probably needs to grow faster, and buying government securities is the old-fashioned traditional way of doing that.
So you think purchasing treasuries then is the way to go?
Well, that's the way it's always been. Now, you may be making a distinction between short-term treasury bills and longer-term treasuries. I don't see that distinction is all that important. I think it's important that it be treasuries of some maturity rather than more mortgage-backed securities and other assets.
You know, Bullard is blaming the Fed's extended low-rate language. You know, we're going to keep rates for an extended period of time low for what could become a deflationary period for the U.S. Do you agree that language could be troubling?
I find that a little bizarre. Most people think that language is a threat to keep policy real easy for too long. He seems to be saying that language means that policy will be kept tight for too long. And I'd like to distinguish between the short-term interest rates and the money supply. And the money supply, if you look at that, monetary policy is relatively tight and has been for some time. The Consumer Price Index headline number has declined for 3 months in a row. We are getting lower and lower inflation, which I think is a good thing. At some point, we might have to worry about deflation. But I'm happy with inflation coming down.
So you think then it's true, the bigger risk is deflation as opposed to inflation for the economy right now?
I think so.
Yeah.
I think so. I don't think there's built-in inflation in the system yet.
I see. And you think that quantitative easing is the best weapon against deflation then?
Well, I hesitate to call it by a new name because it makes people think there's something drastically different. I think old-fashioned open market purchases of government securities is appropriate when the money supply is growing too slowly.
I see. And how would you characterize things right now?
Things have gotten weaker. The recovery, I think, is still intact. It's fragile. It's lost some of its momentum. Policy is getting trickier.
Okay. So how did that happen? I mean, when we spoke with Alan Greenspan 2 weeks ago, he said that the economy hit an invisible wall in the month of June. Why have things gotten weaker? To what do you attribute the most recent dip?
Well, I think things were going along pretty well before Greece, and then before Greece infected the euro. It shouldn't have had that much impact over here, but I think that's the psychological hit that we took that caused everybody to reassess. And I think that's pretty much over with. I think we're okay right now if we don't have another surprise.
And is there anything that you see in the corporate earnings period that perhaps makes you feel like at least the corporate sector is doing well? I mean, there's one area of the economy that people say really is the bullish area, and that is the corporate sector. The fact that, you know, we've got $1.8 trillion on balance sheets. What are you seeing out of this most recent earnings period as far as playing into all of this?
Profits are good. Institutions have a lot of liquidity. All that's positive. However, it's hard to get a lot of new investment if consumption isn't there. It's like a three-legged stool. Everything sort of depends on everything else. And consumption is the big enchilada here. It's 70% of the economy. And consumers still need to save, and they can no longer save by counting on the equity in their house and their portfolio. The only way they can save now is to cut back on consumption, and that's the thing that's going to haunt us for the next couple of years, I think.
Yeah, and corporations just aren't adding new heads to the payroll. And why do you think that is?
Well, I think it's because they don't see the consumer backing it up. They want to make sure that the demand is there and will be growing. The way it is now, they're counting on demand from abroad, and it's good that they have that, but they need some from domestic sources as well.
All right, we will leave it there. Good to talk with you. Thanks so much, Bob McTeer. We appreciate your time tonight.